Good morning, everyone. This is Dean Rogers, Senior Analyst with Kase & Company, and thank you for joining us for today's chat session. In today's session, we're going to go through a couple of little nuances with the Kase DevStops and the stop indicators, the multi or directional, bidirectional stop indicators in Kase X and Kase Private Label. So we've had a couple of people ask me some questions about the stops. A lot of people really like the stops. They're very simple. And we think that they're, very important. So we're going to go through some of those methodologies and some of the logic behind the stops and just some of the various uses for them aside from just being a stop. So we'll go ahead and take our time to go through that. All right, so let's address, what is a stop. I mean, I think most of us know, what a stop order is or what a stop should be used for. And it's a way for us to basically manage risk in a trade, get out of a trade if the market's moving against us. And we can use them in several different ways for taking profit, cutting losses, protecting our risk, or protecting our trade, protecting profits, whatever it may be. We can exit, fully, so you basically put a price order or an order in, a stop order in, stop loss order in at a certain price level. If that gets hit, you can do it on hit or on close. Lots of different methodologies for a stop, and basically a stop order and what it's going to do for you in the sense of getting you out of a trade, whether that's fully out of a trade or partially scaling out of a trade at various levels, like we have with our dev stops. We have 3 different levels. We could even use those to scale out of a trade, especially if we're having a little bit more of an investment type of strategy where we're holding over a longer period of time. And as a market reverses against us and we're willing to take more risk, we might be able to exit parts of our trade at Dev 1, Dev 2, and Dev 3. So let's get a little bit more into placing stops. How do we want to place stops? And the methodology that we use is a trailing stop. So the base of this is a trailing stop. A trailing stop trails price movement. So if I'm, like in the illustration here on the right side of the chart, if I'm in a long position and the market's rising, my stop is going to rise with the market. So it's trailing the move up. And generally the stop is calculated from the high in a move up. You're going to take the high minus some value. Now that value might be fixed, that value might be variable, but basically that's your risk amount. All right, so here's an example of a trailing stop, fixed value trailing stop. Now this isn't necessarily the method that Kase uses. We're building into the method that Kase uses. This is a fixed value of 250. So as the market is rising, we are taking $2.50 away from the highest swing high. Okay, so at this point, as the market's moving up, like for instance, when the market's moving up, I don't have a pointer, you can see that the stop trails the move up. But then when the swing high is made, and we're not making new highs, and the market's declining, the stops flatten out, so that we have a fixed $2.50 off of that swing high that ultimately could be hit. And when that stop is hit, then we execute our order to exit part or all of the trade. Okay. The challenge with a fixed price stop, let me go back here. The challenge with a fixed price stop is you have to know how much you're willing to risk, and that risk amount has to correlate with the risk in the market and the time frame or bar length that you're trading. So what I mean by that is, like in this chart, we used $2.50. And you can see that that stop was held or barely just hit in a couple of places as the market was rising. But if I was using a $1 stop, it would have been a much different picture. We would have probably hit the stop much more often. This is a daily chart. Now on the daily chart, the range of trading, or the true range of trading each day, might be $3. So if I'm using a $3 or a $1 stop, I'm more than likely, odds are, I could get stopped out at any point on any day. Because the range of trading each day is 3 times greater than my stop value. So that's the challenge with using a fixed price stop is you have to make sure that the amount that you're risking and what you're using for your stop value is going to be, one, something you can afford, but two, something that is going to be wide enough to allow for your trade to, your profits to run, but also tight enough to stop you out when the market reverses against your position. So that's the key to having a stop. And I'm not saying that fixed price stops aren't bad. It's just you have to be very aware of varying market conditions. You know, even if we're trading a market that is fairly regular and a $5 stop has usually worked, well, there may be times where the volatility for that market increases, or for that time frame, that bar length increases to such a degree that $5 is too tight of a stop to let profits run in a meaningful manner. So again, we want something that's going to be a little bit more dynamic in adjusting to varying market conditions. And we're going to get into that in just a moment here with our Kase DevStops. Now, one of the other stop types that we talk about, and you'll hear me talk about this every once in a while when we do live trading example, or when we do go through trading examples, is the inactivity stop. Inactivity stops is kind of a discretionary. It's not really, I mean, it's not really a stop. You know, it's not a stop order or anything. It's basically just a way to say the market is not moving in my favor. It's not hitting stops. It's not really doing anything to help me here, so I'm going to get out. And generally, we will look at inactivity stops after 5 to 8 bars of inactivity. Intraday, you might use 8 to 13 bars, give it a little bit of a longer period of time. But on the daily or higher, we usually look at 5 to 8 bars. If the market's been moving 5 to 8 bars against you, like we see here in these examples, basically, if you were short in any of these examples, the market is not moving in your favor. It's not giving you any kind of advantage in the market. And we've done studies. I don't have a long time ago, so I need to dig up the results. I tried looking for them yesterday, but I couldn't find them. But basically what it looked at was after 5 to 8 bars of inactivity, the market moves into a situation where you could, it could break in really either direction. So it was best just to kind of get out, take a step back from the market, take a deep breath, and look to see, okay, are we going to break higher or lower, and then take a corresponding trade in that direction. All right, multiple bars of true range. So true range, this is where we start to talk about dynamic stops. And so true range is the concept that Wells Wilder introduced, at least that I'm aware of. Wells Wilder introduced in his book, New Concepts in Technical Trading, back in the mid to late 70s. And true range is something that we use in a lot of our methodologies. You guys have heard me talk about true range quite often in these chat sessions, and I will continue to talk about true range because it's a very valuable tool to measure market movements. Our case bars in TradeStation and Bloomberg are based upon movements in true range. And it's a big part of what we do in our momentum indicators and in our DevStops. So true range is basically the maximum distance of trading between two bars. The formula is shown here as true range, or TR, is the max of the high or the close of one bar ago minus the min of the close of one bar ago or the low. All right, some people show this as a more complex formula that has 3 parts to it, but really when you come down to it, it's this is the very simple formula that you use when you're coding it. Wells Wilder, when he came up with this idea, he wanted to use multiples of true range. And so he would look at true range because true range is giving you a basic measure of trading between each bar, whether those are daily bars, 5-minute bars, 4-point bars, whatever it may be. It's a very basic measure of volatility. So whenever we look at a stop and we want a stop to be dynamic, the best way to adjust for the volatility of the market is to use some sort of measurement of true range. Now, the simplest of this was to use multiples of true range, and the I don't know exactly. I'd have to look it up in Walt Weiler's book what exactly he used as his multiples. I think he probably used like 2.1 and 3. Those seem to be numbers that I recall. But the numbers that Miss Case started using when she used this idea when she was trading oil back in the 80s and early 90s, she came up with the multiples of 1.7, 2.5, and 3.6. So these were the multiples that she used. So she would look at the average true range over a period of time. Usually she would do 30 bars. And then use 1.7, 2.5, and 3.6 times the ATR to give her stops. And so these basically gave her 3 various levels to monitor for a warning. The first level was like a warning. She wanted to monitor the market more closely if it was hit. The second level was usually an exit. That was generally her exit point. And the third level was an emergency stop, something that she would always have in place. And so whenever she was long, she would always, long or short, she would always have a stop in place at the 3.6 times ATR. And that way if the market turned suddenly against her, she would get out there. The second level was an exit, where if it was hit intraday or whatever else, she might get out. So here's an example right here of Microsoft, a 15-minute chart using these stops. And the nice thing about these, again, is that they're dynamic. They're going to adjust the volatility of the market. So when the volatility decreases, when the average true range decreases, and the market moves into a low volatility situation, the stops are going to tighten. So that if you get a breakout move against your position, you're going to get stopped out sooner rather than later. Whereas when the market goes into a high volatility situation and you need to give your trade a little bit more room to play without getting stopped out prematurely and getting whipsawed, the stops are going to widen because your average true range is widening with the volatility. And so that's why these stops are a step above the fixed price trailing stop. We still use it as a trailing stop. The difference here is that we're using the multiples of average true range. Now, as Ms. Case went through and was looking at these multiple average true range stops, here's another example on a MetLife 15-minute case bar chart, of the stops, 1.7, 2.5, and 3.6 multiples of average true range. But one of the things in this case really started to think about and look at was, even when you're using multiples of average true range, it doesn't necessarily take into account the distribution of volatility or variations in range. And so even though the stops were more dynamic than a fixed price trailing stop, they weren't as dynamic, they weren't statistically significant. There was no statistical significance to them. And what I mean by that is, let's take, for example, these 2 bell curves that I'm showing on the chart here. The bell curve on the right, well, both of the curves have an average of 450, okay? Now these are normal distributions. They're evenly distributed on the right and left-hand side. That's not normal for the market. We'll get into that in a moment. But we're talking theory here for a moment. So both of these distributions have an average of 450. But on the left, the bell curve is a very wide distribution. This is like a very high volatility market where you're getting a large variation in the range of true range or volatility. And so on the left here, one standard deviation is 50 points. Whereas on the right, it's mimicking a low volatility market where you have a very narrow distribution of volatility. So in this case, one standard deviation is 16.7. So a very big difference, even though the average true range is 450 in both of these. There's a very large difference between the standard deviation. And so when you look at it and you look at the outliers, and you look at the 97.5% probability point, on the left you're looking at 550, and on the right you're looking at 43.4. So there's a very big difference. So really what it's doing is if you're using multiples of true range, it's going to give you a very different stop value for 1, 2, and 3 using these different 3 times the average range using these 2 different distributions. So to make it statistically significant, what we wanted to do was use standard deviations. This is what Ms. Kase came up with, and this is what makes our DevStops unique, is she decided to use standard deviations of the average true range. Now the average true range is taken over 30 bars. And so now we're getting into what we do now, in this modern day with our DevStop indicator and with our stop levels in Kase X and Kase private label. Now we end up using, you could say, okay, right off the bat, I want to use a 1, a 2, and a 3 standard deviation move. Okay, so 1 is going to be 1 standard deviation right around usually the 85th percentile. That's including the left-hand side of the bell curve, so that's the entire curve. 2 standard deviations would be around the 97.5, and 3 standard deviations would be 99.9. So, when you're looking at a normal distribution, and again, I know that what we have on the chart is not a normal distribution, but again, we're talking theory here. If we want to know, basically, when the market has reached a certain point where it's kind of the point of no return, we're looking at the 99.9 percentile. The market hits the 3 standard deviations. If it hits that 99.9 percentile, there is a very, very, very small probability, less than 1% probability. The market's going to turn back in your favor and continue to move in the original direction that you may have established a trade in. So that's our emergency stop loss. That's where we got to get out. At Dev 2, you're looking at about 2.5% probability that the market's going to turn back in your favor. Very small probability again. So, most of the time, once you hit Dev 2, you may actually look to scale out of some of your trade. And generally, we don't teach it that way. We teach, to scale out at Dev 3 or get out at Dev 3. But you can scale out at Dev 2, especially if you're in a market that's counter-trend, you're trading against the trend, or you're a high-risk trade. A trade that has a high-risk level that you normally would not have taken. And the Dev 1 is basically a deliberate exit where maybe we've had some sort of warning signal or exit signal ahead of time that told us, hey, we need to get out of this trade. And so that's what the 1 standard deviation mark is. And then we have the warning line, which is right at the mean. Now, taking this a little bit further, Ms. Kase really started to look at it, and at first she was using 1, 2, and 3 standard deviations. But she wasn't getting the kind of distribution that she thought, with the stop that she thought she would get. And so really when she started to look at it very closely, there's an inherent right-hand skew in volatility in the markets. And just like there is with price in most markets. Okay, most normal markets, markets that don't go negative, like spreads or whatever it may be. So, she really started to look at this and say, why is that? Obviously, the answer became pretty obvious quickly. And really what it is the markets are bound on the left-hand side by 0. Okay, volatility can't go below 0, price can't go below 0. But on the right-hand side, theoretically, they're infinitely bound. Okay, so any kind of stock or commodity is infinitely bound on the right-hand side. Not that we, see astronomical prices in all cases, but it can go further out to the right on the right-hand side of the curve than it can to the left. So you get this inherent right-hand skew. So we did this big study to study the right-hand skew. And when we studied the right-hand skew, what we found was that basically for each standard deviation above 1, you have to correct by 10% to get something that's close to being equivalent to a normal standard deviation. So, for instance, at 2 standard deviations, you correct by 10%, meaning by 0.2. So we use 2.2 standard deviations rather than 2. At 3 standard deviations, you correct by 20%. So you end up having a 3.6 standard deviations that equates to 3 standard deviations. It's not perfect because all the distributions are different across all different commodities and securities and everything else, but it's close enough to par. It gets you closer to what a true standard deviation would be. Okay. Any questions about this so far? I think we're moving along pretty well here. All right. Now the other caveat, and this was really just a smoothing factor that in this case came up with, a way to smooth the distribution of volatility, was rather than looking at just the base average true range, she does something that she calls the double bar true range or double true range. And what the double true range is it's the maximum distance of trading between 3 bars rather than 2 bars. And the reason that she did this was so that it would smooth the distribution of volatility a little bit and give us a little bit of a smoother stop level. So a lot of people that have tried to mimic our stop, usually average true range, and they don't quite get the answer that we're getting, and that's because usually they are not using the double true range. So the value, or the formula for double true range is at the very bottom of the chart. We call it DTR, is the max of the high of 1 bar ago, or the close of 2 bars ago, minus the min of the low 1 bar ago, or the close of 2 bars ago. And we have some examples here that show how the actual double true range works in the 3 different situations. DTR, in the upper right, it would be the high minus the low. Okay, that gives you the maximum trading. In the lower left, it would be the close of 2 bars ago minus the low of the current bar. That's your maximum double true range. And then in the lower right, you've got the high minus the close of 2 bars ago. Okay, so that's one difference, one little caveat. Like I said, I'm just trying to iron out some of the little things that people have been asking me about over the last couple of weeks about the stops. So here's our stops in action. Now this is on a daily chart, Costco, and we've got a rising market. We've got Dev 1, Dev 2, Dev 3. For those of you that are familiar with the stops, you notice that they flip between long and short at various periods of time. So again, I don't have a pointer here, but if you look on the left side of the chart, you can see kind of where the stops cross over and go from being short stops, where the warning line, the red line, is on the very bottom, to long stops where the warning line is on the top. And Dev 3 is the furthest down, or the lowest. The way that we control that, very, very simply, the 10 and the 21 period moving average. Okay? I cannot stress to you that how meaningless that 10 and 21 moving average actually is. It's just the way that we control the flipping of the stops. You guys have heard me say it before in other chat sessions, and I guarantee you'll hear me say it again. When the 10 and 21 period moving average cross, all it does is flip the stops. It means nothing more than that. If the stops are not in the right direction, okay, so for instance on the left side of the chart there, we may have already gotten long before the stops flipped. In that situation, I could use the prior swing low, okay, on that big bar right around probably October 10th as my stop level until my stops flip in the right direction. Either that, or when you're using the stops, you can go in and change the variable of 10 and 21 to something that's faster, like 5 and 8, or 3 and 8, or 3 and 5, whatever's going to flip them faster. The faster you make the moving averages, the more often they're going to flip them. So it's just really a matter of function of those moving averages crossing that determine when the stops will flip, because the stops are, as great as they are, they're stupid. They don't know whether you're long or short, because we don't, this isn't a trading system. It's not a black box. And so different people get long and short at different times based upon the signals. So it's just plotting stops in one direction, okay, on StatWare. On private label, plots in both directions. We'll get into that in just a moment here. All right, so here's another example. You can kind of see how the stops widen out as the volatility gets greater. Okay, this is Humana daily chart, 1, 2.2, and 3.6 standard deviations. You can see that on the left-hand side of the chart, the stops are fairly tight. Then as the volatility increases, the stops begin to widen to give your trade a little bit more play, but also at the same time, set some reasonable risk limits to get you out when the trade's moving against you. All right. Now, the one caveat, too, is with the case bar charts or any kind of range bar chart, whether it's range, Renko, case, whatever it may be, you usually want to use wider standard deviations. And that's because the standard especially with case bar charts. Okay, Kase bar charts are built using average true range. So the distribution of volatility is much more normal than it is on a time bar chart. Therefore, you have to go to wider levels, wider standard deviation levels, to move to more statistically significant levels that would be equate to something like a time bar would have. So generally what we use is, by default, with the Kase bars or any type of range bar, we use 2.5, 4.3, and 7.1. Again, that is because the distribution of volatility on any kind of range bar chart is more normal than a time bar chart. There's not that huge right-hand skew. There's still right-hand skew, it's just not as big or as pronounced. And so we use, instead of 1, 2.2, and 3.6 standard deviations on range bar charts or Kase bar charts, we use 2.5, 4.3, and 7.1. Okay, and you can experiment with those a little bit to see what works for you. All right, and then here we show the reversal amounts. You guys have heard me talk about the reversal amounts when we're talking, when we've chatted about setting up time bar or bar lengths, picking a time frame to trade, picking a bar length to trade, setting up multiple bar lengths, scaling up, scaling down, and most importantly, knowing what chart you can trade. So here, for instance, we have the reversal value shown, and reversal value 3. I'm seeing this on the right. 3.6 standard deviations on the daily chart of MET is $3.07. So that will help me position size or size my position, as well as know that when I'm trading on the MET daily chart, at least at this period of time, which was back in July of 2013, that my risk is $3 per share. If I'm not willing to risk $3 per share and I want to trade something smaller than that, or less risky than that, then I'm going to have to drop to smaller or shorter bar lengths. Okay. Let's see. Oh, my stuff got screwed up here when I transferred it over. One of the great things about the stops, and this is kind of an alternate use for the stops, is our follow-through study. What our follow-through study does is it shows us when a stop is hit or when a stop is closed beyond, what is the probability of hitting the next stop level or closing beyond the next stop level. We did this study over a combined 750 years of data. So we looked at many securities, equities, commodities, foreign exchange, all different types of markets on daily and weekly charts. We didn't study the intraday, but the brief studies, we didn't formally study the intraday, but the stuff that we've done on the intraday is basically the same as the daily and the weekly. And it shows us the probabilities of hitting various stop levels. And so we publish these tables like this. And if anybody's interested in these tables, just let me know. Again, I apologize, my PowerPoint got screwed up when I imported it here. But what this shows us is when the stops are hit, for instance, this table on the top is the daily and weekly, where both the long and short stops are in the same direction, meaning on the daily and the weekly charts. So everything's in the same direction, meaning we're pretty much in a trend in one direction or the other. When the warning line is hit, there's an 85% chance of hitting Dev 1, a 70% chance for Dev 2, a 61% chance of Dev 3, and then so on and so forth for Dev 4.5 and 6, which are 4.5 and 6 standard deviations. Okay. When I hit Dev 1, there's an 82% probability for Dev 2, a 72% probability for Dev 3, and so on. So I can look at a chart or look at a market and say, well, this market's already hit Dev 2. What's the probability of hitting Dev 3, which is at a certain price point? I know that there's an 87% probability based upon this table. Once Dev 2 is hit, that Dev 3 will be hit. So once Dev 2 is hit, there's an 87% chance that Dev 3 will be hit. Okay. Now we also have studies that show close beyond. So the close beyond Dev 3, once Dev 2 is hit, might be 83% probability, 83% of what it would be. So I've got a whole smorgasbord of these tables that you all are welcome to take a look at. So if you're interested in them, let me know. Shoot me an email, dean@kaseco.com, and I'll send you the link to where you can download them. On the bottom, this table it's basically the same type of table. It's just the stops on the daily and the weekly are in opposite directions, meaning you might have long stops on one and short stops on the other, or vice versa. But you can see that the stops are, the probabilities are about the same. And so pretty much, almost rule of thumb, I mean, it's not exact, but pretty close is, once one stop is hit, there's usually around an 80–85% chance the next stop's going to get hit, and then it declines by about 10% per stop level from there. Okay, so that's just a quick rule of thumb. So I actually use these in the forecasting methodologies in my weekly forecast. All right, so just to summarize things, stops, very important. A lot of people spend a lot of time trying to figure out when they want to get in the market and where they want to get in and how much and how big their position size is going to be, and all that's very important. It's very important. A lot of people really overlook the importance of exiting trades. Not only looking for exit points like divergences and overbought, oversold like we look at it with our KCD and KSPO indicators, but also managing the risk and getting out, cutting losses. I mean, more often than not, when I talk to successful traders, it's about managing risk and cutting losses. Letting winning trades run, letting your profits run, and managing those profits. But exits, like Brandon, you're right. Exits are where the money is. You got to get out of the trade to make the money, right? But at the same time, you got to know when to cut your losses. And I know nobody ever wants to. I think a lot of times we spend so much time looking at the market. I know I've done this. You spend so much time, you feel like your analysis is perfect, and you get in, and you're like, this is perfect, this is going to be the greatest trade ever, and this is awesome. And the next thing you know, the market's turning against you, and you're like, no, that's not what it's supposed to do. My analysis was perfect. I was spot on. I mean, this was like the perfect setup. And all of a sudden you think, well, maybe it's just kind of a head fake, and so you kind of start writing it out, and then the next thing you know, you've got a trade that's gotten away from you, and you've lost more money than you were willing to part with in the beginning. So, this is where stops. This is one of the hardest lessons that I've learned trading, is just knowing when to cut your losses and step away. And stops are a great way to do that. It kind of takes some of the emotion out of it. It's just something that's, put it in place. If it gets hit, you get out. And yeah, you still get whipsawed from time to time, even using the methodologies of double true range and standard deviations and the DevStops and stuff like that. It happens, but it's less likely to happen. One, and two, you're looking at statistically significant levels. So, yeah, even though there was a 2.5% chance, when you hit Dev 2 that the market may continue in your favor, it was a low probability. And more often than not, when Dev 2 is hit, you're not going to continue to be a favorable trade. But there's a 2.5% chance that it could be. So it happens from time to time. Stops are very important. I can't express that enough. And I think it's something that's very integral for trading systems. I think it's very important. I've had a lot of people ask me about trading systems. That's actually like one of the areas on our forum that we have going right now, is the trading systems. So for those of you that haven't gotten on the forums yet, jump in there, jump in the trading section. And we've got a couple of people, I think a couple of people in here today actually attending, have a chat going about trading systems and methodologies that they're testing. So jump in there, join the conversation, kaseco.com/forum. There's lots of, it's a brand new forum, so it's pretty empty right now. But get some, throw some stuff in there. I monitor it every day, and I want to get in there and get some conversations going with all of you. All right. So if anybody else has any questions, feel free, as usual. You can check out our website, kasedatware.com and kaseco.com, just to give you guys all a heads up. In the next couple of weeks, I'm going to be launching a new kaseco.com website. Ms. Kase and I are going to start a very active blog, both a video and written blog. And so we will be talking about all kinds of stuff. So I encourage you to keep an eye out for that. Obviously, you guys will get an announcement about that. If you have any questions, email me, dean@kaseco.com, or you guys can give me a call. So I appreciate it. Thank you all for attending, and you guys have a great day.